where I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, we're going to talk about what the ADP report, I think, is telling us about the beginning of the end. We're starting to see some serious employment issues. Let's get into tonight's video. Oh, welcome everyone. It is Wednesday night. What I want to discuss tonight is something that I've been talking about for a while, and possibly the ADP report just revealed something. We had a look at the report. We had only 37,000 new jobs. There's pretty much losses across the board. Not looking good for as far as the employment situation goes. And I know it's ADP, right? So it doesn't really mean much. But, you know, if we look back over the last year, I said the ADP might be the most realistic of all the reports around the employment situation, primarily because what we saw of the books being cooked over the last several years to make things look good. Now we're seeing everything slowing down. The border's closed. The folks aren't pouring across the border. They're not able to throw numbers out that they were before during the Biden administration. So now we have a bit of reality coming in. And it's just possible. We're going to get some interesting numbers tomorrow. It'll be Thursday. We'll get claims, continuing claims. They're expected to show a little bit more increase, but nothing material. But what if we start to see those numbers start to jump? And on the continuing claims, I'm going to tell you that the 2 million mark has been my high water mark for a while, actually for a couple years. And we've stayed between around 1.8, 1.7 and change. And we've just been migrating up. We're getting up to about 1.9 and starting to work toward that number. So we could see some things come out of this that are going to start to signal some weakness. Meanwhile, markets just keep doing what they're doing. We had what I would call a pretty boring range today. You know, we just we get below that 5,900 level on the S&P, and we come right back into 5,900. Get to 60, can't get there. I think 99 and change was the high on the primary session on Wednesday. But the realities is that we're starting to see some things come in, and we're not even to the third quarter yet. But I think by the time we get to Q3 and Q4, we're going to start to see some reasonable ugliness. And it just all the metrics that I'm looking at are pointing me toward this direction. And I've been talking about it for longer, and probably you folks want to hear about it anymore. But we're kind of setting up for what's going on. So like I said, we get the claims, continuing claims, a couple other numbers tomorrow, but that's pretty much what we're looking at. I think in tonight's Substack, I'm going to, every time I hate it, I don't know why I get stuck on personalities, but sometimes certain things get me. But, you know, I saw Ray Dalio's out pushing his 100 years debt cycle situation, and I'll just mention it now, but I'm going to probably feature that in the Kendall report opinion tonight. It's interesting because Ray would like you to believe that I always talk about investing looking in the rearview mirror. So he's talking about the 1945 cycle and it's coming to the end, and he's not considering that innovation and all the things that have occurred in the economy mean anything. So we just automatically are heading for this cliff that we're all going to fall off of, and there's going to be another big reset and depression and all that. He's getting to be right up there with Harry Dent and all these other folks. The good news, and I've said this before, I always respected Ray a lot. I had a friend of mine that worked for him back in the 90s, and always had a great respect. And that was because he didn't talk much. now that he's talking a lot and writing books and doing things and talking to us little people and trying to show us how things work, it's become kind of annoying for me. But anyway, it always triggers me. I started to put this thing out on Twitter, but I'm going to put it out in the Substack tonight. So once again, if you don't get the Substack, it's kendallreport.substack.com. $8 a month, 7-day trial. And there is an option for $80 for a year right now. So even if you're on the $8, you can go ahead and ante up and get a year out. I think it ends up to be $6.50 a day. But it's just kind of frustrating because there are other ways to work through the debt, which I will discuss in there, and I have in the past. The only way to get out of the mess that we're in is to grow our way out. And I think that's what Trump is actually focused on in trying to get these capital investments and try to get people to build things here so we can grow ourselves out of this mess. Because there's no way to do austerity and cut back. You have to do that. Fiscal responsibility is important, no doubt. I'm not saying you don't do anything, but I mean, look at what they're doing already. I mean, I saw something they're talking, increasing the debt ceiling by $5 trillion again. I mean, they just don't get it. I don't know what. Maybe you'll have to be right, and everything will have to collapse. So we'll be forced to redo everything. But these guys, senators, the people that run this country, just don't get a clue. And Trump might have some good ideas, but this is typical, as we've seen it in the past. I've been around a long time, watched a lot of administrations, and it's finally coming to the end. I think partially because of Doge. I see even Elon is kind of turning pretty hard against all these reconciliation bills and all the money that they're spending. They're just spending more. So there's no Doge cuts. Everything ends up to be, just a big lie no matter who's in there. So it's very frustrating from my viewpoint, seeing a really good future. So hopefully we get beyond this, but I think we're going to have to initiate some pain as we go forward. Things have looked and been static, I would say. They haven't really been growing at a big rate. Until we get the GDP over 3.5%, we're not going to get there. Listen, there was China-like growth numbers back in the 80s, folks. I mean, it's not like, pushing 8% plus. So it's not like it's impossible to do it, but it just seems like we're in a big rut. So I think I'll back out of that loop as fast as I got in there. So let's set up for tonight's video, and let's talk a little bit about probably as we set up the end of the week. Like I said, I think by the time we get the employment numbers, by the time we get all the stats that we're looking at coming up with, we're going to have, I think, a big reveal from the standpoint of whether this economy is about to stall and to roll a little bit. And I think that's going to be the case. And I know a lot of folks are, asking, will the Fed come step in and try to fade it? Listen, with the relationship, Powell's out of here, okay? Come, I think it's February, March, whenever his term is up, he's out of here. I think he still will be on the board of the Fed, but he will no longer be the chair. There's no way Trump's putting him back in, even though Trump put him in the first time. But the reality is they're going to keep everything status quo, I think, other than I still am estimating they may lower rates a little bit on the front end of the curve, but I still think it was part of the plan that was put in place a couple of years ago. So if you've been around the channel for a couple of years, I've been talking about this whole evolution of how the Fed is trying to get the yield curve into a certain position. I went to the yield curve last night. We still need the front end of the curve to be around 3.25. It's 4.25 right now, so that's a full 100 basis points, but 50 basis points at 350 with the back end of the curve, 440 on the 10 or so. 450 is where I think the target has been for a long time. And I told you the transition would be to go flat. So we're basically 4.25 on the funds, and on the back end we're 4.25, 450. So we're right in that range. It's basically a flat curve here. So we're really just looking at the, at this normalization situation I started talking about the better part of 2 years ago. So we're there from that standpoint. The Fed's interactivity with the economy right now is minimal. There's nothing they're really going to change the trajectory of anything that's going on. So we're just kind of floating through what the path right now. And I don't see that path changing. And I still think part of the path is 2 more 2/4 point drops. Probably not till maybe in September. October and November is the most likely scenario as we come to year end. And that some of these stats that I've been talking about and the weakening in the economy, we'll start to see all of this coming together. Sort of like watching paint dry a little bit. But we're starting to see little cracks in the surface. The ADP at 37,000 was a pretty low number. And if the employment numbers come in on Friday a lot lower than expected, under 100,000 or something, that's going to start to really get everyone thinking. And I think that will be the point. And it goes hand in hand with the scenario of the S&P just stalling here right at 6,000. It's like, we're at the high. Do we want to make new highs? Like I said, even if we were to make a new high in these indices, I think we get an immediate rejection. I mean, who wants to buy 6150 on the S&P? Right now, nobody. Everybody'd like to buy 5,900 and go to 6150, but no one wants to buy 6150. So I think we'll see quite a bit of resistance we get up there. So let me double check the database here, make sure everything has run, and then we'll go ahead and get into that and go through pretty much what I would call a normal show. Yeah. Let me just. Yeah, we got a pretty good tranche. Okay, let's go ahead and get into it. Okay, so zooming in, we're back at 70%. We got 1,000 new buys after today, which wasn't necessarily a huge big rally, but things have been kind of clawing back. So we got another tranche, and I was talking about this last night. We were going through the video. Is that we're the database going back in 24 on the intermediate kept sticking at 61%. Well, we got back to about 65% here on the short-term database, and that was it from the standpoint of the from the standpoint of what we're seeing on the general rotation that's happening here. Okay, so what? Let's break this down just a little bit. Let's see. We did get a new buy last night in the sectors, so we're up to 8 sectors long on the short-term database, and that's pretty good. Last week, if you recall, we went to a 43% on the intermediate database, so we're above that 42 handle, and everything's starting to get more traction. So while I'm sitting here talking from a negative position here, we are seeing some positive rotation, which, like I said, my big deal is carrying into Q3 and 4 is where we'll see the weakness. We'll see what sets up here. So let's go ahead and go through just looking at the sector returns here real quick. We've got, of the 8 sectors, let me just see if I can get this so it scales right. Yeah, so what we're looking at here is that the sectors that are long, we've got three sectors that are negative, and then we've got the balance are positive. The biggest returns are in transportation and technology, and then we're down to services and healthcare. And one of the things that we did see today also, which is kind of interesting, looking at the contrast of the database versus the economics, we saw services sector actually go into a contraction mode today. And so there's just a lot of cross currents right now, and even right now with this little tranche of data on the getting a blast up here up to 70% again. If you recall, that's part of what my expectation was, that we'd get down closer to 62 to 58. We didn't quite make it there. Then we get this bounce back to 70. So we went 65. Maybe we make even a higher high on the short-term database traction. And let me look at one stat here that I just want to zero in on. So, yeah, for the optimized daily right now, the normal for the optimized, which is the best models for every stock that's in the database on an optimized basis, current duration is 15 of 39. So we're looking at about 40% of this cycle being fulfilled. So we still got a fair ways to go, but remember that the whole cycle is 39 days. So that's a better part of 2 months. So we're reasonably into that cycle, which would put us, toward the end of June, early July would be the end of this cycle. So everything's still pretty much on that tone right now. We'll see if we get any surprises out of the employment numbers and that stuff that comes out. So let's go ahead and kick into the S&P. The S&P just continues. I mean, we've got this little dip in the middle here, but it just continues to just bounce in this sideways range. And it looks like as we come into the next couple of days, we could have some momentum loss happening. Maybe we're going to roll back in. I think we still have to. We hit the 200-day one time. Probably got to retest it. I think we potentially come down in here to 57.50. I've been talking, that number keeps coming up in a number of positions when we look at the daily charts and all that. I was hoping that there was some kind of a trade setup happening here, but this is, if you look at the neutrality of everything, PPM1 is at 0.20, so it's still in that above the momentum. I'll show you the data sheet. I've got that run for tonight for the S&P. But we're just seeing this momentum just strong enough to remain above these key moving averages and stay in this choppy sideways range. So other than trading indices, it's pretty hard. We did see some decent movement in some stocks. Tech stocks seem to still be on fire, but even they, if you go dig into the charts, they're locked into their ranges as well. So everything is into this range. I hope we don't spend, this is the beginning of June. I hope we don't spend, the next couple months and we're still talking about this choppy sideways range that we can't get out of. I think from a health standpoint, coming down to the 40 period moving average, come down at 57.50, 57.30 level on the S&P would be fairly good. So far, there's been a couple levels of the last couple of weeks has been straddle city on SPY or any of those that are around that you can put some option strategies on and just short calls, short puts, just straddle them and take the money. That money's been falling in the pockets for a while, and especially if you layered them up on this little rally here. But this has been like really the only trade that's out there other than day trading and doing. There's not even good swing trades in here because every day, I mentioned this before, I won't get too boring, but if we look at the highs of each day, between 59.44 and 60 even have been the highs. I think yesterday, we printed 59.99, which was, by the way, if you look over here, the R1 was 59.99 exactly. There was a couple of decent trades yesterday. One of the trade setups that were on the sheets were at a 60, I think 60.21 sell. I thought there was a better and even chance. Yesterday, everything was set. It's interesting that we got all these buys coming in on the database from that standpoint. Let me just see if I can. Let's bring up this this board so just see what the data sheet's coming up with here. And we're looking at 65 neutral to bullish, so it's got a slight bias to the upside yet. Range consolidation, neutral zone, equilibrium, mixed signals. I mean, that's pretty much tells the story, right? What we're looking at here is the current pricing. So we got 59.92, just below that 99 high we printed yesterday, 60%. It looks so. Once again, in the yellow is the range. Because of the upward bias, the models are telling us that R2 is a possibility, which is 60.0925. The highs last week was 60.08, I believe exactly 60.08. Might have been a quarter, but it was right at that level. So we're looking at retests of the highs of the range that we've been in, and on S1, 61 to 59.92 is the expected range with the slight bias to going to R2. And we're looking here at down 25 cents right now, 59.80 at last trade. Let's take a look here. You can see the PPM1. I took this snapshot a little bit earlier, but it's at PPM1 at excuse me one second here. Yeah, PPM1 is currently at where it's a maintenance mode. I'm just trying to get the, this is the legend down below. So it's right now it's on maintenance, which means it's above 0.15. Market should stay above that 10-day moving average. PPM2 is at a trend plus, so it's at 0.29, above 0.25. PPM3 is also at 0.42. Gets above 0.5, then it would get a strong trend mode. Double plus T is how I put this legend together. So we have, and then the 200 is neutral at 0.03. So the pattern that's set up is really right here at the S1 R1. That's your trade zone. So that's how I would play this. If we hit sell zone 58.88 to 92, and then buy zone 59.61 to 65. That was pretty much what I was explaining here. Upside breakout would be above 93 and a retest of the highs 60.08. If that trade does come off, then I would just watch for those levels right there. But for the most part, it looks like part of the range bound scenario will continue. Like I said, we get continuing claims, couple normal numbers we get out, nothing earth shocking. I think everybody's going to be watching for the employment numbers on Friday morning when they come out. But you even look at the algos here; they're flatline. I wish I had something more exciting, but there's some decent those trading ranges. That S1, S2 range is probably going to be a good place if you're intraday trader. if you're a day trader. So let's go ahead and go to the NASDAQ here and break through, see what those patterns look like. Like I said, we're typically, the NASDAQ tends to lead. You can see the red dots are trying to get us down. The 10 and 21 day moving average is coming into a convergence point. And so let's just talk about that setup just for a minute here. And especially if let me just zoom over here a little bit. And right where let me bring this down just a touch. So right over at this level, right before this decline, we got all of the, in this case, we got all three averages to kind of come in and almost become the same value. And that's where the market rolled over from that point. So we saw a pretty big rollover. So if we come over here, we're still looking out into next week to kind of get to that, what I call the twist point, where all the moving averages come together. And then if we're going to get a downtrend, they all kind of cascade down in a trend. And until we see that we're coming into that potential moment, and we're seeing that the volatility has normalized, but it's fairly narrow. And if it gets a little more narrow over the next couple of sessions, maybe as we come into Thursday, Friday, I suspect we could get a little bit of volatility bubble, just because we have major news coming out that markets are going to react to. So at that point, we should see some reaction, but it looks like everything's starting to weaken. The one indicator I have been watching is down here. If I just blow this up where this my cursor is, this right here is finally at the turning point where it's saying today is that turning point on Thursday. So when we come into Friday, it's at least forecasting one of those patterns. And I did notice somebody had posted something on our Discord under suggestions, and trying to come up with some ideas. There's a trade that I talk a lot about is a V top or V bottom. There's not one of them here, but we have when we get those setups, they're pretty powerful, and it would be nice to put some more detail into some of the indicators and to locate those conditions a little bit better. Maybe even putting a strategy around it. But these turning points that we're getting here, if we try to line up what we're seeing right now, is right where this PPM3 is starting. Looks like it wants to downtick. That's Friday. So it feels like to me, sometimes, have you been around the markets a long time, you get one of these gut feels, and it just feels like that we might have a little bit of a downside surprise on the employment, whether ADP showed the hand or not, we'll see. Normally, the correlation between the ADP and the actual number, the BLS number, is not usually significant. But I think a lot of these reports that we're seeing now are starting, I don't know, they feel different when I'm looking at these numbers. We're not getting some of the distortions that we saw last time. I'm not sure why. I'm pretty sure that most of the same people that were working in those departments doing and compiling these reports are still materially the same people, but there's not, there just seems to be something that's coming into the market here. Maybe because I've been talking about it for 3 months, and maybe because I have a bias because I've been expecting it to happen, so I'm looking for the lead in, and I think I'm starting to see this. I've been talking about, if you just went back, look at headlines both on Substack and on YouTube videos, you'll see kind of a little bit of the leaning that I've been talking about, the possibility of things rolling over. So let's do a time check, 1/2 the hour. So we'll expand out a little bit. I do want to touch on some of the things that are happening in the treasuries. I covered that last night, went through the yield curve. I won't go to that depth, but I do want to look at a couple things there. And I think we need to keep the dollar, and there's we need to expand a little bit on what we're watching here every day on the channel. So let's go ahead and um, let's go to the treasuries right now. So treasuries took a little bit of a hit, and we're starting. We have some fib targets that are out there right now, and I did not discuss those. We got pretty much tied into what the a bigger picture on the markets last night, but we have a couple. I'll just zoom in on this so you can see these numbers over here. But we've got the low target one, 416, 398, and 387. So this is also interesting that we broke below the averages. This is potentially another signal that we're going to get a weak number on Friday. There seems to be some expectations building in the marketplace. And, even today there was, a pretty about face that happened early in the session. So, but these targets down here would also align ourselves with previous lows, 415, 410, where my cursor is right now. Hang on. There we go. Where the cursor is now. So we could be heading down toward the 200-day on the treasuries, which would put us at 420. And that's pretty much in the range of what I'm expecting as far as the bottom of this range. So let's click over to the weekly just for a sec here. So we'll tighten up the ranges a little bit. We're down into, on a weekly, we're coming into that 21, we're kind of the cluster. I call this the twist point, where all the moving averages come into, they rise into a twist point, and they're forecasted. You can see the dots. These are future forecasts from the indicators. That is where you'll start to see this rollover, and maybe ultimately, and I discussed this in our longer term outlook last night. This is a weekly chart that as we come in to November, we're going to see interest rates starting to slow down. Now, that doesn't mean the Fed's going to do anything, but what the Fed may be able to do, if we do get this down to back to a 410, 4% back end, then you want that, once again, going back to what I talked about last night, you want that pattern on the front end to be 3.5, 3.25. That would be about a 1% span between the front end and the back end. It's much better. 1.25, 1.5 would be better. So I think that the 10-year will start to stabilize between 410, 440. That's been the thing I've been kind of rattling on about for months now. And then the front end of the curve is going to be only adjusted by the actions from the Fed. And I'm pretty sure that if we do get some of these weaker labor numbers, things start to show up, that will be the narrative behind the lowering of the interest rates, is because the economy is starting to weaken and the Fed's being accommodative, all those stories. I don't think that's what's going. I still think it was part of the original plan that I mentioned earlier, that really this was always the plan to get that front end curve, front end down to 3.25, 3%. And then you get that steepening yield curve. And then at that stage, then I'll be pretty bullish on the Russell. And the Russell had a good day yesterday. Didn't look at it today, but it's a long ways from making the big turnabout that you're going to really want to be paying attention. I'll start focusing, depending on what happens in the next cycle as we go through, as we come into July and August, and maybe at that point we can start to bring in, and maybe there'll be a conversation to start to look at some of the small cap stocks at that time. I still don't think there's probably trades there, but there's nothing materially that's going to switch in the economy, not at this time. I think as we come into 26, we will have an opportunity there. So let's go ahead and let's go to the dollar. And I'll stay with the weekly chart here, but this basically coincides with what I was just talking about. Although this is weekly, I'll acknowledge that we have, let's take a look. Yeah. So this is somewhat interesting. We've got 3 Fibonacci targets that came out on the weekly, and I'll zoom in on these over here. Let me bring it up on the right-hand side. So 107, that's a big number. 111, 114 is where these dots are. As I told you before, on these fib targets, typically fib target 1 is a realistic number, and if we look at just from a weekly trend mode, that would be about a 0.6 retracement back up. If we look at that, we're looking at a confirmation from the projections and the on the forecast for the PPMs are increasing with an upward Fibonacci target, so their probabilities are building toward that. There's a but, okay? The but is that we're still in extreme, we're looking at ppm 1 at minus 0.52. That's a serious downtrend, and that would not even be a possibility until we get into July. So we'll see how this forecast comes out. But these lower numbers here would coincide with the Treasury stabilizing here, and unless this gets out of control, there's not going to be a lot of change here. This, by the way, this 0.52 number is huge. That tells us that the 10-day moving average right now, or 10-week. Let me just bring that up. Yeah, that's at 100.03. So that tells you there's a ceiling at 100 on the Dow right now. So the downward trend, as I've been talking about, is going to continue to move to 97, maybe 95. And I went through that long-term outlook last night, but I just want to keep a kind of a short-term watch on as far as the patterns that are unfolding here. All right. We'll go to gold. How about this is the weekly gold. It's kind of an interesting pattern. I've shown this quite a few times in the past several weeks. And this is this big trajectory on the upside. This is way out in the future. Let me just see what I got going here. Just trying to get one of these to come up. Bear with me a second. I just want to see the forecast, what I have it. So it's 50 bars in the futures. So that is quite a bit there. So the red dots here are suggesting we're going to stay above the 10. I've been telling you that from a trading standpoint, I think that you should definitely be anything that looks like the 10 SMA weekly. You want to be a buyer there. Let me just zoom in on this. You'll see the pattern right here. But you want to be a buyer anywhere along this line. I think we stay in this slope. I also went through on the long-term viewpoint the other day is that this volatility bubble that's setting here still has a ways to go before we'll get a normalization and be in any position for the markets to actually start to move to be able to decline below that number. So it looks like 3 weeks, 6 weeks out, we should be able to maintain that number from there. Okay, so um, going to Bitcoin, we're starting to see things stall a bit on the. This is the weekly. I said we still have about 3 weeks in here, and it's going to be. We've got these live Fibonacci numbers up here. Let me just bring that up. So we've got a decent pattern here. The rollover looks like at mid-July. So we've got a number of weeks here where we can stay above and get a swing move up into these fib targets. I'll bring these up over on the right hand side. So target 134, 213, 157, and 171,000 is those big numbers up here. And a lot of times we've got 3 bars here. Just want to, where my cursor is, we had 3 bars over here, which were 97, 105, 113. And if we look here, we went almost exactly, even though they stopped calculating, this swing objective came into this consolidation and kind of flowed. So if we were going to start to look at some of these lines across here, let me just yeah. So we would look at this 113 line right across here. And then the same thing will happen as we get up here. Even if these stop calculating right now, these bars out in the future are going to be bands of expectations coming. So when we start to look at this bigger pattern here, we're definitely there's an issue here which I just happened to notice. This would be the key element here. Like I said, we've got this uptrend still flowing here with the projection of the moving averages. And if we do pull back, we've got to swing and get up and extend up into these levels. If we don't, then the inverse will be the issue, and we'll get something like this, and then maybe more consolidation. I don't think we get down to like this 200. I don't think that's where we're going. So, but I do think we could get into further consolidation, and we could get this whole band right here could be where we get stuck. And if we get stuck there, we'll be stuck there because of all of the market makers and the futures and all those guys that are hanging around the markets right now. So there's no, I guess what I'm going to argue is we have a few more weeks for us to get up and start to get into 121, 134 range. If we don't, then we're going to see more consolidation. I actually do not see any pattern or anything coming out of the algos that are suggesting there's going to be a giant rollover and go down. Although we could see a retest of 100. I would not like to see that at all. I think we're looking at 10. Let me make sure I've got my cursor right place here. Yeah, 103. We've been bouncing off 103. We take out 100, then there are some on the shorter term basis on the daily. There is some Fibonacci targets down here, and let me just bring that up. Yeah, so we do have these 3 fib targets here. And they are suggesting right now that we're looking at 97, 8, 70, 92, 4, 89, 139. I think if we did break 97, 8 better hold, or there'll be more damage to the markets. But this pattern that we're getting here is bringing up the algos, is getting fairly close to a potential bottom of this little mini sequence. So I think we probably end up holding 100. We got to give this another shot at this one. I think it was 112 was the high, something like that. Yeah, 112 exactly on this exchange anyway. That was the exact high. So you got to get over 112. If you can do that, got to run 121, 134 has got to be the next targets, or there's going to be issues. So as I've been saying for a while on Bitcoin, is I really think this is kind of one of these potentially historic areas that it's time to run. If it's not going to run here, it's going to have further consolidation, and we may have to go through the whole summer or coming into fall before we'll be in position to try to rally again. Okay, just coming back up here. We're a little early tonight, so that'll make up for some stuff. Let me just see if there's anything's going on here. Yeah, I agree with Oleg. It's like Bassett is right person who found a way to QE without the Fed. Yeah, that's they're going to need to do some pretty creative things here. Um, yeah, the buy the dip scenario is still on. There's some still good scenarios there. Let's see here. Okay. Let me look a couple more comments and we'll see if we've got. Yeah, so David Ford, you're right. You know, how long does the markets get to tread water before they get tired? And that's basically what's going on here. I think we're pretty close to that moment. And like I said, but I don't see any big things coming down here right now. Just looking at some other comments. Yeah. And just bear with me a second. I'm looking through some of these. Yeah. Anyway, I think what we'll do is I was just hoping there was something that would interact. Um, but I guess here's what we'll talk about at the end. I'll just kind of summarize. I still think that the employment numbers that we'll call them employment numbers, we'll do air quotes on that, but the ADP may be a look into some of the weakness that's about to hit across the board. I don't have a pretty picture for the rest of the year, folks. I really don't. I know markets are sitting here. We could have one good day and be at an all-time new high. But like I said, someone might want to buy 59.80 to trade up to 61.60, which would be the high on the S&P, but no one wants to buy 61.60. You know, I said, well, if you could only get long at 61.60, would you want to do that? And I don't think you would. You'd want to own them from here, trade up to 61.60, and then decide from there if you want to keep holding. But the realities is things are kind of coming to a rollover point, and the lack of silence. And I did see the comments that Trump posted on talking to Putin. That thing's not over. So much for I'll have the war over in 2 days. Of course, a lot of things have happened since then too. This last little bombing run that Zelensky and the folks did has made the possibility, and they knew this when they did it, of any type of settlement that would take all that off the table. So everything that we're seeing is deliberate, to say the least. So who is behind it? I don't know. Who knew what? Don't know that either. No one does. And certainly no one's talking right now. So we're kind of getting into a point where a lot of gibberish has been put out and not a lot of action. We'll see how everything plays out around this employment number. So I will call it quits here. I appreciate everybody coming and your comments and everything. And we'll be back same time tomorrow. Make sure a couple things is that you actually will get. You should get the indicators. There no longer is a rent to own or subscribe. It's buy only. We took that out just so you know. So if you were waiting and trying to decide that, that's no longer. We're going to be doing some new offerings. Coming out very soon. I have been working on getting the WaveTech models into TradingView. I'm fairly close on that, so there's going to be an update on the indicators. So those of you that already have the indicators will be able to get that package. You'll be able to get an add-on package, and then there will be probably a slight price increase on the indicators after that announcement. I think we're a little ways away. I think we're probably 60 days away from having that, but there's a number of things. Also, the data fact sheets that I show you every day, those are going to be part of the package as well. Once we get a couple things done, while the world of programming has gotten a bit easier since I can now participate with the IT group, and I did do a lot of the remapping and restaging of the WaveTech models as well. So we're working on some pretty cool stuff. So keep hanging around. I'm glad to be back up. I think this is month number, working on the third month of being back on YouTube. So everything's going along. There's some really cool stuff coming. There's a lot of intelligence coming in because of the AI, that probabilities, forward-looking ideas, and things that are going to be forecasted without basically, we joke virtual Bob, and so you'll have the thoughts when I'm reviewing the database that's being built into the new versions of the WaveTech. So when I'm doing the analysis of the models every day, you'll just be able to you'll have that at your fingertips, because that same analysis will be done right straight from the data every day in the models, in the software. So anyway, looking forward to a lot of stuff, folks, and we'll talk to you soon, and we'll see you same time tomorrow.